India is extremely vulnerable to this. We have never seen the kind of disruption because of destruction. This is something which is unusually different.
Hello and welcome to Investors Hangout, brought to you by Aditya, Birla Sun Life Mutual Fund and Value Research. Now, last week, Dhirendra Kumar wrote something that he had never written in the past 30 years. He wrote that this time, this too shall pass may not hold in the same manner. And hundreds of readers, they wrote in asking, what does that mean? How is it different this time? So today, we'll answer that question and much more. Dhirendra, for the past 3 decades, you've told investors to stay put through every crisis. What is different this time?
The big difference is that this is not about the mood. In the last 35 years, we have seen that there are economic changes. We have never seen the kind of disruption because of destruction. In the 90s, Indian economy was undergoing a transformation. New capacity was coming up. We were setting up manufacturing businesses of a different kind. This technology boom, the dot-com boom, and a lot of capital chased few companies. Many companies died on the way. There was inefficiency of capital allocation. Too much money chasing too few companies. Euphoria getting built in a part of the market. The global financial crisis. We saw that something happened and there was a gross misbehavior by investors. Investors started speculating in an unprecedented manner. And it had a ripple effect on the economy overall, and then it got transmitted to the whole world. This is something which is unusually different. This is different because it is not about a change in mood. Some capacity has been destroyed, and that capacity may not be very significant. And there will be many things and a lot of things will be done to recover that, or it will be repaired, it will be redone. But it has real life impact. It is not a mood change. It is not something which is supply of money or some value getting destroyed because something changed in the market. It is real money. It is real asset which is leading to disruption, and that can have a ripple effect. I'm not saying that it is all doomsday. It is just that India is extremely vulnerable to this because once our currency weakens, and once we see this disruption of a kind which is such a significant energy source for us, and we are so vulnerable that 85% dependence on import of crude, and that is getting disrupted. And when it will get restored, this is a capacity which is not getting restored there overnight. That is, it was an eye opener for me. I got alarmed when I started I got a briefing from some people who worked there. And they were describing the scale of damage done, and then I delved deeper into it to understand that what exactly happens, how it works, what goes on, and that made me think that this is not as simple as it has been ever in the past. That doesn't mean that nothing will be done to amend this. That doesn't mean that there will be some kind of unintended negative effect and unintended positive things. A lot of corrective things will be done. There will be alternatives found, because I still strongly believe in human ingenuity, that everybody will try and find a solution to a problem.
So, while the coping mechanism might kick in, what does it mean for recovery?
The recovery is not dependent on natural recovery. That, okay, people will change their mood, or, there'll be reversal. Because when it comes to mood and the market and the sentiments, or even the money flow, there is always a reversion to the mean, because there's no distraction. It is that we were very optimistic about something, then we became neutral, and then we became pessimistic. So the pendulum is always swinging between this range. If you have something disruptive happening, which will start affecting the price at which we borrow, the way at which the rate at which the supply chain will get disrupted, it may not get restored for a while. That can change the economics of many of the industries. It can translate into something very damaging. And it can also benefit some sectors or some companies or some industry or some segment of the market or some geography very differently.
So you're saying that the recovery might not be V-shaped, it might be U-shaped or gradual L-shaped recovery that will finally...
Yeah, I'm saying that we don't know about the recovery, because first things have to really, everybody has to buy into the idea that, okay, we need normalcy. And we are looking at a different world altogether. Somebody just decides that, okay, they have to get into a war. This whole alignment, I don't know what, because never in the past I have seen a situation where something has not been done primarily as an economic driver. This is being done, and we are moving back and forth, and this is a disruption of diplomacy, and complete realignment of the geopolitics.
So let's move on to some of the readers who have written into us.
I'm actually very surprised by the scale of enormity of or the volume of responses. Hundreds of mails. I have never seen this barrage of response and anxiety among people. More so because I've actually been a very soothing writer. I say that it'll be all right, and normally it will be. For the first time, many of our readers, they are hearing from me that I am little alarmed. So that is actually provoking them to think that it must not be all that. There must be something unusual, and that is what I have shared with them.
Right. First up, Hemanta wrote in. He's 35, salaried. His emergency fund is in place. Short-term money is in debt. 90% of SIPs go to equity. He wants to know if he should continue.
Absolutely. In fact, for somebody like Hemant, he is lucky. If you have a long-term orientation, the world will, on any 5-7 years period, I feel that the world will be a better place. Markets will be rewarding. The only thing is that right now things look little grim. Things don't look like poised for an immediate turnaround, which we have gotten used to in the last 5-7 years. And the whole government, all central bankers, governments, economies, they all work together to prop up the market. That may not happen anytime soon because the damage is something in physical. And it'll take its own course. But for somebody like him who still has 25-30 years to work, make sure that you don't lose your job, and make sure that you are able to carry on with this plan. And if you are able to carry on this plan, I'm so optimistic about the future that somebody like him who sticks around will be a big beneficiary. In fact, sticking around may be a little uncomfortable, because we have been, in the last 5-7 years, large number of new investors have come in, somebody like him. And we want to be continually happy. That not only that we will be optimistic about the future, but even on a day-to-day basis, we'll be happy by looking at the portfolio value on Value Research Online. Don't look for that. If you get a modest return, and if you get little less than fixed deposit in a brief period of time, or for next 1 year, 6 months, or whatever, feel happy that you are buying at lower prices, and buying high-quality assets. Buying high-quality assets which will be very productive. And right now, you are getting a phase of market where you'll be able to buy at a steady price, or I don't know, that it's almost telling you that I'm very confident that the market will remain the way it is, or will go down. I don't know. There is a possibility, very likely. In fact, whenever I have tried to guess the market, I've been generally wrong. But this, my opinion is entirely based on me being influenced by the Prime Minister's speak, and trying to delve deeper into what is going on and what kind of damage that has happened and how scary it could be. But very likely, I'll be very happy to be wrong.
So, Hemanta, the message for you is that your SIP is doing exactly what it was designed to do. The best thing you can do this week is do nothing. Now, moving on to the next reader. This one's a harder case. A retired viewer, Sridhara Dasappa, he wrote in. He says he has no pension, invested 12.5 lakh rupees in stocks, 3 lakh rupees in mutual funds. SIPs are still running, but he needs 40,000 rupees every month for his daily needs and medical expenses. He's been liquidating stocks to fund it. What should he do?
Sridhar requires a careful planning. 5 lakh rupees, nearly 5 lakh rupees, the annual income requirement. And this is a small part of it. 15 lakh rupees invested in stocks, or 5 lakh rupees in mutual equity fund may not be a complete picture. And if it is, then the situation is grim. This is 4 years worth of money, and it'll get exhausted if, it'll be less if we see a fall in market dramatically from here. So he should get in touch with somebody who can plan his finances, look at his income requirement. Normally, it should not be more than 6% of his capital, his annual income requirement. And if it is more than that, then he has to worry. And that is the paradox of investing in equity for the long run for a person like him, because the more higher the income requirement, more vulnerable you are to a sustained declining phase of the market. And that is when you should be actually working in a more conservative asset allocation. For somebody like him, it should be less of equity, more of fixed income. And that is the way you will be able to protect the worth of your capital. You will not be depleting your capital in a down market. And it's very important to carefully plan your withdrawal and taking a holistic view of your finances.
Now, this is the group that several readers fall into. Prashant has 3 crore rupees. He's planning to retire in a few years. There's another reader who says that he has his goals set for 2024 through 27. Abin Paul has a 7 to 10 year horizon. What should they do?
These are the people where something can be done very significantly by careful planning. One is to decide on the asset allocation and be at it. Work on rebalancing every 3 months, every 1 year. Because somebody like you are getting close to a situation where you know that how much money you have accumulated. You still have 5-7 years to plan. You still have time to calibrate your investment in such a manner that you can estimate that what is likely to be your income requirement. Is your capital good enough to support that? And how you should be configured. And you still have time on your side to plan it. Work on your asset allocation, rebalance annually, make sure that you are able to weed out the duds, be into good funds, well-performing fund. If you are unable to choose it, get into index fund. At least you'll be assured of a certain degree of participation with predictability, and be disciplined with your rebalancing. Don't try to. And it's very important for them to make sure that they are not doing something awkward, which is get scared at the wrong time because you are getting closer to the retirement. Panic at the wrong time, and that will nullify years of work, years of disciplined savings, and that misstep could prove very expensive. Unusually, so many people were asking about what should they do about gold. And you should not be buying gold or you should not be selling gold. One should look at gold, and we have discussed it once earlier. And I would like to just reaffirm this, that look at gold as your insurance. Gold is not a productive asset. And for long, I have persuaded a lot to great disappointment our readers that keep away from gold, and that has turned out to be very disadvantageous. I have changed my mind that make sure that it is, and it is proving to be a very unusual asset. Central bankers are buying it, and it is able to guard the price value, but it turns out to be disappointing every now and then. So make sure that it is 5%, 10% of your allocation, and you are investing in that as an insurance, that when everything else will look very grim, this might hold value.
Now, I want to read you one email that I think captures what many people are feeling. So, Kaveri Anamalai, a CFP, she wrote in. She says, I have built my beliefs on equity as a phenomenal asset class for the long run, a lot from your readings. But this passage of yours is making me rethink my strong beliefs. So, will equity still be the same asset class that we should be in?
That is your only promise. And that is a promise worth believing in. I don't think it is any time to give up on that belief. Equity is the best performing asset class over any long period of time. And in India, it's more so, because we are not Japan. We still have billions of people who get up every morning, go and work, add value, produce something meaningful, provide a meaningful service, and earn our living. And if we have this going on, and if we still have a large population which gets to work every day, still growing, still rising, and every segment of the Indian population is upgrading itself. There are more poor people who are becoming less poor. There are more poor people who are becoming middle class. There are more middle class people who are becoming upper middle class. Everybody is aspiring to upgrade his living. Everybody is upgrading his quality of life. So every reason to be very, and if this happens, if next 5 years we are going to be better off with our quality of living, the kind of opportunity, then it will be a better market, and market will be a beneficiary of this by providing just the goods and services to support all this. These are disruptions, and these are disruptions which all I am trying to get the point and attention to is that we might not witness a complete V-shaped recovery. We have seen market going down and coming back again. We have seen even after the global financial crisis, after 8 months of steep decline, we saw that in another year and a half, the market made a big recovery, and we were back to the almost the same levels on the Sensex. That is something which may not happen quickly, because now it is rooted in. It is not based on just investments, cyclicality of market, change of sentiments. It is based on some capacity being destroyed, which has a real life implication on the economy in general.
So, from this episode, my takeaway is that while this crisis is different, how you deal with it is not supposed to be different. Equity is still your bet, and match it to your timeline, act on the plan, not the headlines. We'll see you next week.